Well, good morning to everyone. Welcome here. Welcome to Miami. For those of you listening, it's drizzling and windy, and you would not have had a great morning in Miami, but it's going to be a great afternoon, so you should have come. It's going to be beautiful here. It's 80 degrees. Watsco is selling air conditioning today in Miami. We're certain of it. And last night we went to dinner. We were all sweating and having a nice night at dinner, so that's good for business. Welcome here. I'm Barry Logan, Senior Vice President of Watsco. It's been about 4 years since we've done this, and it's important to do it once in a while to get a personality behind the company, understand some of what we're up to, what our thinking is, more importantly, what our ambitions are, and introduce you to some of the team that is part of that. So again, welcome here, and we appreciate you being here. First, a little bit of it on the agenda. Who's going to be here today and talk to you and answer your questions? First, most of you know me, and maybe either fatigued by listening to me. Well, today's another day. We'll hear some of what I had to say, but most importantly, we have a team, or really a lot of our senior team here. Steve Rush, who is the COO of our domestic business, is going to talk about Watsco today. Charlie Figueroa, who is our international vice president, who runs our businesses outside the United States. And Paul Johnston, who is a big personality in this industry, a great asset for Watsco, and he's going to take you into some of the more interesting long-term vision and pictures and issues that excite us. And with Q&A, our chairman and CEO, Al Nahmad, will join us and answer any questions. For as long as you have questions, we'll be happy to answer them. It takes 17 hours. We'll be here 17 hours. And then we'll have lunch afterwards. So again, welcome here. We're glad you're here. First, the Watsco story, some of the basics. First, some growth rates. We entered distribution in 1989. So this is a chart that shows a 25-year track record of our company. Revenues, you can see, growing from $64 million to $3.7 billion, about an 18% growth rate. The 25-year compounded growth rate is what I'm showing here. EBIT, 23% over that same period of time. Our share price, dividends, going from $1 million back in the day to over $80 million last year. Our market cap going from a mere $22 million, think about that, to a value of $3.3 billion. And if you'd invested all that time, how did you do? Because we also paid you a lot of dividends. You're up 9,630%, 20% compound growth rate for 25 years. But by the way, if I put up 40 years, it'd be 16%. So what a track record. And I can tell you this, none of us are satisfied. None of us feel like we've accomplished enough. Ambition is very intense. And again, ask questions later. We'll go through some of the texture of what the company is up to. Feel free to ask a lot of questions. So the humility part of it is that our market share is only about 10% in North America, 10% of a $35 billion market. That's good humility to suggest that the company can be much larger. Number of locations, about 570 locations today versus 16, 25 years ago. That's going to grow. We certainly see our business having well over 1,000 locations. And why? Because there are 89 million systems, 89 million that are over 10 years old, and every one of them will break. The machines do not care what the economy is or what the banking crisis means or anything. They're going to break. Same number of units are going to break over the next 10, 20 years as would have otherwise. And they're all going to have to be fixed, replaced, repaired, upgraded, because no humans want to live outside of an air-conditioned or heated space. So good fundamental business. The fun question isn't, what did you do? What have you done? Let's look in the past. And the better question is, what next? What is possible? How big can the company get? How profitable can it be? So what do we see? What do we imagine? We see a $10 billion company. How profitable? We see $1 billion worth of profitability. How long will it take is the next question. It may take a long time. But we set our sights on being a $100 million EBIT business. It took us about 9 years. We said 200. It took us about another 6 years. And we're pushing 300 million now in terms of profitability. So we certainly, again, are ambitious. We're having fun at this. And that's what we can imagine, and that's what we want, and that's a guarantee of what our chairman and CEO is expecting of this company. A little bit about the strategy, which we've gone through before, but for those that might be new or listening, I'll cover it. We call it buy and build. We want to acquire great businesses and build them. Not wreck them, not consolidate them, not integrate them, not go through the process of destroying a good business. Buying a great business and building it. Very simple. We are a builder of brands. There are great brands in this industry that have been around over 100 years. We want to be a great partner to those who own those brands, be a distribution company, a sales company, a marketing company that builds those brands. And we're just getting started. There are a lot of brands in this industry we don't represent. Some great name brands in this industry we don't represent. We see it as a long-term opportunity. Technology, we're doing a lot with technology. We're not going to talk about it at all today. I'm being a little facetious when I say that. But we see a great long-term opportunity to innovate in our industry with our vendors, with our customers. And we're having some fun, again, imagining what to do. And now it's execution, and some good things are happening. We're the only public company. We think that's accomplished two things. Transparency is one. Really getting our vendor community, our supplier community engaged, excited, ambitious with us, and transparency helps that. The other, obviously, is equity. We've done 3 secondary offerings in the last 25 years to raise capital. Some of our bank group members are here today, have to compete against that with a very competitive bank line. And again, as a public company, that buys us a very low cost of capital. It really lets us, again, imagine doing anything with our company because we have the capital to support it. Insider ownership, about 15% of the outstanding shares are owned by insiders. It's always been that way. It's growing. Many of you are familiar with the Cure Enterprise transaction we did 4 or 5 years ago. We had 49 people that got equity. 45 of those people are still with us. You know the results of Cure Enterprise. But there are about 400 people across Watsco where we've shared that philosophy of equity. No one else has it. Our competitors do not. Capitalization, again, what we've always talked about, having a great balance sheet. We hate debt. We do not like debt. We disdain all forms of debt. We still have some. Why? Because we're conservative, but also we want to build our company and have a very low cost of capital when we do. So very simple. In terms of some of the basic macro trend, we know energy conservation is on the minds of every business, almost every consumer, every government official in terms of a long-term capability to conserve energy. And guess what? Air conditioning and heating together use more than half the power in a house. So a good long-term opportunity to be part of that, either through mandates, regulations, good principles, whatever it might be. And if you're under 30 years old, you're thinking in those terms 24 hours a day. So we like you as a customer long-term. Long-term focus. If we miss a quarter, we don't make a quarter, we tell you why. If we beat a quarter or have a great quarter, we tell you why. But long-term, we want to get to the $10 billion target, the $1 billion of profitability. And if it takes a long time, that's okay. If it's get rich slow, that's okay. We've been at this 25 years, and we'll keep it going. In terms of markets and products, 86% of what we do is in the U.S., 14% is outside of the U.S. in Canada and Latin America. Canada and Latin America was 0 2 years ago, and I mean 0. And Charlie will be here to tell you a little bit more about our international business and a little bit of what his ambitions are to grow that part of our business. In terms of products, about 64% of what we do are machines, equipment made by the big primary OEMs. Everything else is about 600 vendors that make everything else the contractor needs today. In fact, they need it in the next hour. So if your machine breaks, how quickly do we need to respond to a customer request? Within the hour. Our lead times are an hour. Our backlog is therefore an hour. So it's a very quick service requirement with inventory, technical help, everything the contractor needs. And Steve will talk and develop that a little bit more when he speaks. Financials, this is year to date, 9% up in revenue, profits up 21%. I've characterized this as a very good year and a very consistent year. We're seeing very consistent growth rates in both the replacement market, the commercial market picked up for us in the third quarter, and the end markets, primary end market for us is replacement of air conditioning systems. And again, as the consumer has performed better and just the simple requirements of these machines, heating and cooling, it's been a good year. Back to the long term, this is cash flow. I think any business can grow its earnings. The question is, can it grow cash flow faster? That's real value in our estimation. So our operating cash flow has in fact done that. Over the last 10 years, we've generated over $900 million of cash flow versus net income of $820 million. If I put up 20 years, it looked very similar. I don't think many businesses have that simplicity of execution on earnings and cash flow. We're not the only one, but there aren't many. Dividends, we've paid meaningful dividends over the last 10 years too. We'll keep doing so. What does that mean, meaningful? It means we want to raise our dividend every year and generate cash flow and pay as much as we can and still be conservative with our balance sheet, but forever pay an increasing dividend, assuming the company's financial position and everything is intact. That's what we've done, and that's what we'll keep doing. You can see CapEx. I love the CapEx number, $64 million over 10 years. We're that big box warehouse over by the airport that we pay $6 a square foot for. So bricks and mortar come very cheap for us. Our primary investments in CapEx is technology. And what better thing to spend money on? So today, again, doing some innovative things, but CapEx relative to cash flow is a good deal as a shareholder. So it lets us have a lot of flexibility to pay dividends, to invest in our business, to add branches, to add products without competing for large capital projects. Our business in the U.S., Steve, if Steve Rush come on up and just give a little bit of profile of our U.S. business.
Wow, I heard 10 billion, 1 billion twice during Barry's presentation. Good thing I'm a young and energetic guy. Good morning, everyone, and welcome to the Watsco Business and Analyst Conference. Unlike Barry, many of you don't know me. I think some of you met me 2 years ago when I spoke at this group, but just to give you a little bit of background, I am currently, and for the past 2 years, been the Chief Operating Officer for Watsco Domestic Operations, responsible for what you see up on the board here. Prior to that, I served as the president of a couple of different Watsco operating units. GEMAIR was the most recent. Prior to that was Comfort Products Distributing, which prior to my going out to Omaha, Nebraska from Boston, Massachusetts, figure out how that happened, it was actually 3 companies that we consolidated into CPD. And today, CPD resides as part of the Carrier Enterprise JV, one of the operating units within Carrier Enterprise. So oftentimes you hear Barry talk about our 4 business units. I want to look at it a little bit differently. I want to look at it from an operating perspective, because I never think 4. In the U.S., I think 11. Okay, I think 11 operating units. And quite frankly, if I can get granular, I think beyond 11. I think 517. And the reason for that is much of the very exciting numbers that Barry shared with you today, they come on the back of domestic operations, right? 86% of the total sales come from these 517 locations. Every one of these 517 locations are their own P&L. They share common services in a variety of ways from the different operating leadership units, but they all manage to their own P&L. And they're all rewarded for performance against that P&L. So 2 years ago when I spoke to you, I talked about our reward for performance culture. I'm happy to say that has not changed. We continue to very strongly believe in rewarding people for doing well. We reward behavior. And I think it's even more prevalent. In some of our operating units 2 years ago, this reward for performance based type of management did not extend through their entire operation. Today I'm excited to say that all 517 of these operating units, if they perform well against their P&L, they're rewarded for doing so. And I mean everyone within that 517 locations. It could be a truck driver, it could be a counter sales guy, it could be an outside sales guy, it could be a warehouse guy, it could be a custodian. It makes no difference. If those locations perform well, those employees get rewarded well. And I think that speaks largely to the success that Watsco has enjoyed over the past 25 years. Our leader, Al Nahmad, recognizes the importance to reward people when they do things appropriately. And I'm happy to be part of that culture myself. Okay, our leadership, let's talk a little bit about our leadership. I talked about 11 operating units. We have the Carrier Enterprise, JV, which prior to our acquisition was looked at as a single, very centralized operating entity within Carrier Corporation. Al had the wisdom, once we executed the JV agreement, to recognize the importance of decentralizing some of that responsibility and putting the ability to make decisions and provide autonomy closer to the transaction, closer to the customer. And at that time, we broke up, not broke up, but we decentralized Carrier Enterprise into 4 regions. They were comprised of the Northeast, actually 5 regions, the Northeast, Southeast, Florida, and then Central. And in Mid-Atlantic, I'm sorry, that was the 5th. When I took over my responsibility here as a Chief Operating Officer, I said, this is good. You know, I said, it provides us relatively good visibility into Carrier Enterprise. But we have this monster out in the middle part of the country that stretches from the Canadian border in North Dakota to the Mexican border in Texas and comprises part of the Mid-South. Now, any of you who know the geography of our country and know those different geographical areas know very well that there's nothing common between Bismarck, North Dakota, and San Antonio, Texas, right? I mean, it's completely different. So to try to manage an entity as large and as cumbersome as that and do it singularly, I thought, didn't make a lot of sense. So back a year ago, actually, in February of 2013, I decided, along with Al's blessing, that we were going to break up Carrier Enterprise Central into 4 operating units. So what we now have today is we have 11 operating units within the U.S., 8 of which are Carrier Enterprise, with individual leadership, all autonomous, all able to drive the strategic and tactical direction of the companies. And then we have the legacy companies, which you're all well aware of, I'm sure, Baker Distributing, GM Air, and East Coast Metals. So that's who we are, okay? But as you can see there, we have 650 commissioned salespeople. Those are guys and gals outside on the road that drive business every day. We have 50,000 customers. I think that number is actually larger than that. It's closer to 60. Our operating companies either share or compete for these 60,000 customers. Imagine the excitement that creates. Imagine the interaction and some of the potential channel conflict. Every one of our operating units intends to be the best in their markets. And every day they're competing against other Watsco-owned companies as well as other competition. None of them are going to be satisfied to be number 2. So it makes for a fun day on Monday when I walk in there and have about 88 emails from the previous Friday trying to ask me to help them manage through some of those channel issues. But it's fun. And I think, again, it's just what drives our culture and what makes Watsco as successful as it is. Okay, we talked about empowerment. Actually, a couple of years ago I did. What does empowerment mean? Empowerment means no one in this room today that represents Watsco is driving the performance or the operation of Watsco US or, and I'll let Charlie speak more directly to this, Watsco International. Our businesses are not driven from Coconut Grove. Our businesses are driven in the field. As I mentioned earlier, the strategic and tactical direction of every one of those operating units and the decisions associated with them are made by their operating leadership. What we do at Watsco is we provide resources, we coach, we provide guidance, we hold to task, okay, we track and measure, we execute and leverage scale and provide that benefit to those operating leaders. But at the end of the day, the people out there are the ones that are responsible for driving those exciting numbers that Barry shared with you a little bit ago. It's fun stuff. Okay, we manage our performance, not every day, but we manage it throughout the day. And every one of our leaders do as well. And we're not going to talk technology, but trust me, we have the resources at our disposal to have our finger on the pulse and know what's going on by the minute in real time. Okay? 517 locations, measuring performance, real time. What does that enable us to do? It immediately allows us to identify outliers. Every one of those 517 locations is responsible for contributing to the revenue and earnings growth of the mother company. If one fails, just one fails, in my world, that constitutes failure. Not acceptable. So we need to continually monitor the performance, communicate with the leadership, again, provide guidance, provide direction, whatever is necessary to ensure that I don't fail. Because one failure is a fail. One branch fails, I fail. Okay? We talked about 10 billion, 1 billion. Again, you're going to hear this throughout the day. It's not a dream, it's an expectation. And while none of us understand completely how long it's going to take to get there, we're going to get there. And it's going to come on the heels of these 517 branches, these 11 operating units, but not exclusively. We also recognize a need that in order to get to achieve that goal, that we're going to have to do several additional things. We're going to have to grow organically. We're going to have to expand our brick and mortar footprint. We're going to have to expand those 616 commissioned sales reps potentially. We're going to have to diversify into other channels, into additional space. We're going to have to continue on the acquisition mode, something that Barry is focused on daily. So there are a lot of things that are going to contribute to that 10 and 1. It begins right here, though. It begins with the 11 operating units. It begins with the U.S. It begins with what Charlie is doing internationally. Reward for performance, again, we talked about it right down to the branch level. Our senior leadership at every one of our operating companies are rewarded for 3 things. Any idea what those 3 things are? I'll tell you. First and foremost, and this is important to our major vendor partners, we're looking to grow and reward share growth every year. Growing revenue and growing earnings is okay, but we don't want that to come at the expense of share growth. Our goal and our expectation is that every one of those operating companies are going to grow share in every market and in every segment of the business that they participate in. It's not a dream, it's an expectation. Okay, we expect revenue growth coupled with share growth. We expect aggressive revenue growth, and the only way you get share growth is if you grow revenue at something greater than the industry growth. So our expectations for our operating companies and our 517 branches is not that they're going to perform to industry level. That's not acceptable for us. We need to exceed industry performance in order to realize share growth at the same time that we're realizing that revenue growth. And then finally, earnings growth, right? And that's what feeds all of us. That's what feeds our investors. We need to grow earnings. And our expectation, I'll just give you one number, and it's the only number I'm going to give you today in terms of that, is we expect some multiple, 3 or higher, of revenue growth. That's an expectation, not a dream. Okay, and we expect that from the 517 up through the 11, up through the 4, and ultimately to Watsco. That's how I manage U.S. operations. Okay, how do we reward our operating leaders when they get that? We use 3 basic means of reward. First and foremost is cash. Okay, Anna Menendez will tell you, and you'll hear from her as you talk to her at lunch, cash is queen in our company. Cash flow is one of the major driving factors of the success of Watsco. But our people feel the same way. Okay, there is this instant gratification expectation and need that we address and make sure is taken care of. You know, every time that it's warranted. The other thing that we use to reward strong performance at our leadership position is stock options. Every one of our company leaders, every one of our operating leaders, and down through several tiers of their leadership ranks, they all benefit and have a benefit today and will continue to benefit from stock option rewards when they perform at a high level. And then finally, restricted shares, which are restricted in most cases to our senior leadership, including the operating leaders in the domestic 11 operating companies, and I'll let Charlie speak to his. Okay? All right, so we talked share growth, we talked reward performance, we talked about measurement. The other thing that I think is important for us to consider and talk about today is, who do we do business with? Okay? We do business on the inbound side with hundreds of different vendors, dozens of which are major vendors, and then we have the 60,000 customers on the outbound side. So everything that we do and aspire to within Watsco needs to take into account the vendor relationships and the customer relationships. Nothing we can do can come at the expense of either of the other two. Okay, it needs to be a collaborative effort, one that allows us collectively to share in the success of. The vendor partners we have, the dozens of key vendors, to them we represent their one chance, in most cases, of having a successful year. In almost every case, we will be their largest customer in the U.S., in the world probably. Okay? So they depend on us heavily for the success of their companies. I don't take that responsibility lightly. I don't take that relationship lightly. It is my job and the people that work for me's job to ensure that we grow their brands right alongside our brands. Okay? It's not our brands at the expense of their brands. And at the same time we're growing our brands right alongside our vendor brands, we need to ensure that our customers are sharing in our growth, sharing in our vendor growth, and growing right alongside the two of us. So this is a collaborative effort that starts at the manufacturing side and goes right through the fulfillment, right through the fulfilling contractor. Okay, talked about 10 billion, 1 billion. 517 branches, 11 operating units. Who knows what it's going to be next year when we talk at this session? I can tell you it won't be 517, 11. I'd be disappointed if it were. We're going to continue to grow. We're going to continue to invest. We're going to invest in technology. We're going to invest in channel expansion. We're going to invest in product expansion. We're going to invest in brick and mortar expansion. And I sure as hell hope that Barry's going to find some other very attractive companies out there that we can attract into the and become one of our acquisition partners. So I thank you for being here today. I thank you for the opportunity to speak with you, and I look forward to chatting during the question and answer period.
Good morning. Buenos días. Bienvenido a Miami. Of course, since we're in Miami, we have to have a little bit of the local color and flavor. I'm going to introduce myself like Steve, and then we can get into the international portion. Actually, I'm Steve's little brother. I account for about 15% of Watsco's operating revenue. And that's made up of really a handful of operations. But before I get to that, I'd like to talk a little bit about myself. I joined Watsco 3 years ago, and after that, before that, I was with Carrier Corporation for 35 years. I lived in a handful of countries with them, running their operations in those countries, and I spent 15 years in Latin America and roughly about 6 in Asia, between Taipei and Melbourne, Australia. 3 years ago, Al asked me to join his company to run his international division, and I thought it was a great idea. Because what's most important is to try to grow in operations, have fun, and create wealth for our shareholders. So that's what we're focused on doing. I want to start with the Watsco culture. I'm not going to get into every detail, but this is shed over our international operations. We operate in 3 separate languages, French, Spanish, and English. And, that's everything from invoicing to acknowledgments to collection and everything. We operate as separate subsidiaries in these countries, and we span a geography in Canada, for instance, of 6 time zones. So we are deeply ingrained in the culture and in an operating entity. We have country strongmen, if you like, general manager that runs all our operations. We sell everything from a window room air conditioner through a centrifugal. We have the whole line of HVAC equipment, and in some operations, we also service that equipment with service entities. So that gives you a little bit of an idea of that. Our culture is the same. We pay for performance. We have the same metrics that Steve does, and our leaders are focused on that. If we talk about Canada, for instance, our biggest operations internationally, as I mentioned, at 6 time zones, revenues just under $350 million. We have 36 locations, actually. We just opened 36th in Kingston. And from those locations, we sell the parts and supply side and also equipment. One of our major strategies is to cover more of Canada. As you can see from the map, Canada is rather large. It's very different, as Steve's is, when his comparison between North Dakota and San Antonio. Ours is the same as we deal with the province of Quebec and Vancouver. Very different cultures, very different applications for our HVAC equipment, very different temperatures. We have 329 employees, and our strategy is to continue to grow those employees, continue to grow our locations in order to cover and gain share. Our Canadian operation is a strong EBIT margin provider, and our challenge is to grow the top line. Our challenge is to develop and increase our market share. We are the leader in market share, but it's not easy to stay and maintain. So our objective is to grow that share, and along with that, the profits and cash flow. As you can see, the mixture in our product portfolio, residential is the biggest piece, followed by parts and supplies, and then what we call the commercial and applied area. Again, Canada is operated as a single operating entity. It does everything from invoicing to filing tax returns to borrowing money, etc. Now we have our Latin American operations. Within Latin America, we cover everything from Mexico right on down to, as you can see there, Peru and Ecuador, and the Caribbean basin, with the exception of Cuba. Someday we'll probably cover Cuba. I've got to tell you that when people ask me where I'm from, I tell them I'm from Jersey. I try to cover my accent a little bit, but I also continue and say I'm from Jersey via Havana. So that's why my interest in Cuba, perhaps, for future dates. But as you can see, we took over from Carrier in 2009, the Latin American entities, and today we're at roughly 240. It's good growth. It's profitable growth. There are entities that need to be managed. As we all know, Latin America can be volatile, but they need to be managed. And that's the leadership that my group and I try to provide. My role is one of being a mentor to my general managers and give them the experience that I've had in my roller coaster through Argentina and Brazil and etc. Over my past years. We have operating entities in Miami that export. to over 32 countries. Of course, Caribbean islands can be countries too. We use Miami as our hub to export. It's a very good, profitable part of our business. It was one of the first exporters set in Miami to cover this territory 30 years ago, and it continues to be a very good and profitable model. We believe that, and based on our target, our Watsco target of, as Barry mentioned, of being a $10 billion operation, our goal internally for international is to double our size. And I think it's very possible in this and our Canadian segments. Our markets here in the Latin American side are over $2 billion. It is a growing market. As you know, the per capita income in Latin America is rising. Mexico, Colombia. Colombia is back from the old days in the 80s and 90s when the FARC were running around. So our countries are booming at this point in time. There's some exceptions. Venezuela is down, but we always have these types of things. Our strategy within Latin America and our export business, but I'll get into Mexico later, is to grow our parts and supply business. We find that to be very lucrative. To continue to expand our equipment through additional coverage within countries, through contractors and dealers, because obviously we sell centrifugals and that's through contractors. We deal through different channels into these countries. And our footprint and brands. Having said that, we'll get into Mexico a little bit. Mexico is a standalone operating entity, very much like Canada. It does everything right through borrowing in its local currency and filing taxes locally. We have a general manager in place and his staff, and we cover the entire country of Mexico, all 150 million people. As you know, in Mexico, we've had a change of government recently, and the PRI is in after being out for a significant amount of time. The PRI is more of a populist regime, if we can remember in the past, sometimes called socialist. They were in power in Mexico for over 30 years before being dethroned. They have instituted many new policies, but the country, as identified by all, still has tremendous opportunities. In Mexico, we operate with 11 locations at the moment, and our plan is to more than double that. Presented a plan out to try to increase our locations by 14 and move forward with that over a period of several years. In Mexico, we do everything from window room air conditioners to centrifugals, and we service that. So it's a full integrated HVAC and refrigeration operation. We deal with several brands that we purchase from our major vendor and partner Carrier, and we deal direct on the part and supply side through our total line stores. Our goal, as you know, and I'm just repeating what my big brother said, is to supply our partner and vendors with share of market gain as our first priority, to increase our sales and revenue within these operating entities, and to provide shareholders with the EBIT and profits commensurate with our efforts, and obviously to hit our cash flow targets so that Ana Menendez doesn't beat me up every time I come to Coconut Grove. Those are our targets. So far, we've been successful. We love this train ride we're on. I wouldn't get off it for the world. With that, that's all I really have to say at the moment. And I then bring it and introduce Paul Johnston, our Vice President of Business Development and Strategy. Paul? And stuff. Okay, sorry.
These guys all get colored slides. That Barry gives me. That tell you a lot. You know? First of all, let me explain. It's not that I don't want to look you all in the eye. I've had some eye surgery here in the last year. Had it again. That's why I wasn't on the call. Missed all your wonderful questions this time, but I just have to wear this. I'm very sensitive to light. And I have a tin can out there with some apples in it if you'll help me out with that little effort too. So, I was really excited this morning. I heard both Steve and Charlie mention North Dakota. That is my home state, and I am an alma mater of the University of North Dakota. And I just want to say to anybody out there who's from North Dakota that this is the week. This is our 124th anniversary as part of the U.S., so I thank you, North Dakota. You guys are celebrating that, I'm sure. I'm going to talk about some of the things that are going to go on in the future. You know, not too far out in the future because nobody really knows what's going to happen, but some of the things that are going on in regulation, some of the things that we're doing to take advantage of trends that we're seeing in the marketplace. And so we'll start with refrigerants. I think that was, probably the big news in the first quarter when the EPA all of a sudden moved up the allocation of R22 in the market. That was a headline in our world because we've been on a steady stream of phasing out R22. R22 is the gas that hurts the ozone. It also hurts. It's big in global warming, so it's something that's bad. However, there's 60 million units out there that are still operating on R22. So we're watching constantly to see what the supply and demand is of what R22 is doing. Back about 8 years ago, we were using over 200 million pounds of 22 in this country. Now we're down probably in the 60 to 80 million. Nobody really knows the exact number. The allocation from the EPA was only 61 million pounds for 2013. We know in 2014 it's going to go down to 52 million pounds. And we don't know because the government isn't telling us what it's going to be for the next 4 years. It phases out to zero in 2020, which means something has to happen to all that equipment out there that's operating on R22. So that's something that we watch. We're trying to identify what happens with that. It drives a lot of things within our air conditioning industry, as you can imagine, and that's why it's important. So as it continues to ramp down the R22, it ties us into the next bullet, and that is energy efficiency. Because obviously, if you've got to replace these 60 million units that are operating on R22, you're going to have to replace it with a 410A machine, which is the current type of refrigerant that we use today. And that machine generally is going to be more efficient. It's not going to be ultra efficient, but it's going to be more efficient than what the R22 units were. The other thing about energy efficiency is we're all waiting for this regional standard change. That's going to be probably one of the questions you ask. And right now we're putting a question mark on that. We just don't know if the regional efficiency changes are actually going to hold out, if it's going to even happen. And so we're just in kind of a watch and wait situation. It's something that doesn't really impact the Watsco. It does impact, obviously, all the OEMs who'd have to ramp up to make the higher efficiency 14 SEER product, or they're going to have to ramp down and make all the SEER 13 equipment. So energy efficiency right now is kind of like I say, it's kind of a question mark in our minds. What exactly is going to be happening there? The next thing that we look at, and this gets into our $10 billion, $1 billion plan, and that is logistics. For us to make that plan, we've got to do some things with logistics. We're going to have to figure out how we can take our footprint, which today is about 13 million square feet. It's a lot of square feet. And even though it's not high-end real estate, it's expensive real estate. And so what we want to figure out is two things. One, how can we make our footprint more efficient, denser, so we can cover more territory and satisfy more customers? And how can we also take the inventory that we have in there, which generally low fours turnover, how can we improve that with the art of logistics? And that's part of what we're going to get into in the future on our technology drive. But also, just as importantly, for us to hit the 10 billion, that means we're going to have to add more SKUs. We're going to have to figure out better ways to replenish. We're going to have to figure out how we can move our equipment and our parts at a faster pace. We now have an international arm that has to be integrated into this. So logistics is going to be a big future play in the Watsco story. Ductless. I think every meeting we've ever been to, I've talked about ductless. And ductless doesn't mean that Minnesota farmers aren't going to let you shoot on their land. It means that you don't have any duct work anymore in the unit. Every place in the whole world, except for the U.S., uses duct-free equipment. And basically, it runs a refrigerant line from the outdoor unit. You run a refrigerant line into this room here where you'd have some units up there that would have the coil and the blowers already built in them. You'd be able to set the temperature precision right there. You won't feel a rush of cold air on your body. It's almost perfect. If you took a look at the entire world of air conditioning for split systems, there are 90 million split systems put out every year, or at least there were last year. Of those 90 million, 85 million were duct-free. That means we use the rest of them here. There are huge companies out there that are making these. The product is growing in the U.S. So far in the first 9 months of the year, it's up 18%. 18% of your shipment numbers that you see from your OEMs are duct-free. 18% growth. It's still a small market, but it's growing. The second part of duct-free that we really get excited about is something called variable refrigeration flow. That is a hot one. And what this does is it allows you to have 25, 30, 40, 50, 60 units indoors with one outdoor unit, and it's going to manage the refrigerant flow amongst them as you call for hot air, cold air, whatever you want. You can call for hot air in this room and cold air in that room. So it's a marvelous machine. That market in the U.S. right now is up 31%. So what we've done at Watsco, we positioned ourselves to meet growing markets. We saw this market starting to grow several years ago, and we've been behind it and focused on it ever since. And finally, controls. Controls are another big future. Big changes happening in controls. I think has anybody heard of the Nest thermostat? Yeah. And that's what that is a Wi-Fi enabled thermostat. So what you can do is now you can operate your thermostat, right on your iPhone. Really mess around with your wife or mess around with your maid, turn the temperature up and down. It's really the way of the future because it's allowing people to control what their indoor temperature is no matter where they are and to be able to see what's actually happening to it. The estimate right now for this year is there's going to be about 1,100,000 of these Wi-Fi, not just Nest. There's a number of other players that make these things. And that this market in the next 3 to 5 years we see growing to around 6 million units. That's a great number. Because what happens in the U.S. is there's probably about 10 to 12 million thermostats sold. The problem with thermostats is they're all cheap. About 84% of them are on the bottom end of the price scale. And what this has done is it really is creating a situation where there's some excitement built around a thermostat. Maybe you guys don't get as excited about thermostats as I do, but it is exciting. And really it's getting into a lot of other different channel partners that we're looking at there. You're getting into a lot of people want to control the temperature in your house or want to get inside your house. Your security company, your cable company. To name two that are actually advertising probably in your neighborhoods that they want to get in and have security and temperature control. This is all good for us because it puts the focus, once again, on something that the consumer's been pretty lazy about, and that is the temperature in their home and trying to manage the energy efficiency of their home. And so I think it's dynamite. Now, there was a recent survey that was done, probably one of the best ones I've ever seen, by Florida Power and Light, where they asked consumers about, have you ever been caught changing the thermostat in your house? As your spouse or your said, hey, did you change the thermostat? And it was amazing. 76% of the people did it and would admit it. Those of the 76 that wouldn't admit it said they just denied the whole thing. I didn't touch it, honey. Another 20% of them blamed the dog or cat And another 10% said that obviously, honey, you must have bumped into it. So, I mean, it's becoming more news, and I think it's good for our industry when we get news like this. So with that, I think we've covered my colorful slide here. So thank you, and I'll bring back up Barry Logan.
Thank you, Paul. That was fun. I'd be more than happy to answer any questions anyone has, and we're all here. So anything is open and fair game, and any of us might answer it, and fire away.
Questions? Yes, sir. Thanks. I was wondering, as you go to the $10 billion in revenues, yeah, thank you, and thanks for hosting this. First off, as you move to the $10 billion in revenues and $1 billion profit target, maybe if you could talk about the geographic mix primarily, and or if there's any change in product mix. And I guess in addition, if you could address the risk profile or the cyclicality of Watsco going forward, as you're very well penetrated, of course, in the U.S. Sun Belt, but as you go outside of that, does that dynamic change?
Well, we are no longer just concentrated in the Sun Belt. We started that way. We're in 38 states. We're in the Americas. Our strategy is the Americas. So geographically, we're positioned in the Americas, and that will provide most of our future growth, the Americas, defined from Canada all the way down South America. And you were asking how we're going to get to the 10 billion, what some of our thinking is?
No, I'm just asking how does the cyclicality change? I understand that.
No, I understand. Well, one of the values of what we do to an owner is that we don't deem ourselves cyclical. Why? When new construction takes off, we enjoy it. When it comes down, which is cyclical, we still enjoy it because we're in the replacement business primarily. The replacement has always been our focus and will continue. You can't have 60, 80 million homes out there with machines that are getting old and will need to be repaired or replaced, and that's our market. As I said, now new construction is improving, and we'll do some business there, but it will never amount to the biggest part of what we do. So I would take cyclicality out today and in the future.
So can I just rephrase this then maybe? Are the markets, as you're looking internationally, are they the same as what you're dealing with
Not
in
at
the
all.
U.S.?
That's a very good question.
And
Those
then
markets.
also, Al, if you could address the weather question, because clearly in Canada and in the northern part of the U.S. different than the U.S.
Let's take that part first. Seasonality has always been part of our company and always will be. And that's why we don't like to project quarters, because you can have a weather pattern that will influence our demand that comes in the second quarter, and sometimes it doesn't start until the third quarter. And it could be a matter of days. Every year we'll have seasonality, and that will move away the demand throughout the year. But in the end, we know that the weather will contribute to our growth. Unless you have, a frozen world and there's no need for heating or some catastrophic thing like that. But seasonality will always be a part of it, but I think that only influences the year, during the year, not the end performance.
Thanks. Ryan Merkel, William Blair. Wanted to start with the 10% EBIT margin goal. Could you just talk about, I know there's no timing on it, but you'll do a little bit more than 7% this year, So we got about 300 basis points left. How do you think about the mix of gross margin and SG&A expense leverage for that? And secondly, could you speak to the 4 business units? Is there different characteristics about those units where one will be higher, one won't be at the 10%? Maybe just speak through that as well. Just frame it for us.
I'm going to bring somebody else into that question. Who wants that one? Ann, are you shrinking away over there? I see you shrinking away.
To answer your question, we both look at both things, obviously expanding the gross profit margin and SG&A. I can tell you that today we have business operating units operating above that 10%. So we know that we can get there. Most of the operating units are very similar, depending on, some are a little bit different in every market, but for the most part, we define them either as equipment houses, primarily, that's their core competency, or a parts and supply house. But they all sell the same things. So if it's an equipment house, we'll bring in parts and supplies and vice versa. So today we have operating units operating above that. I mean, Steve talked about the 11 operating units. So that's on the domestic side, and then on the international side, it's actually 15 operating units. And when you look at that mix of operating units, we know that today some of them are operating at above 10%. So it's just a matter of continuing to leverage the scale and performance.
Yeah, the expectation is for all 4 business units and all 11 operating units and all 517 domestic branch operations to be operating at something north of 10% ROS. That's the expectation. There are no exceptions. No one's getting a ride on this one.
And
For
there's
those
incentives out
of you who don't
there.
know, Anna Menendez is the company's chief financial officer.
And then we actually have incentives out there to reach some of those targets.
Yeah, those restricted share things I talked about earlier, they're hanging out there, and it's an attractive award. A lot of people working to achieve it.
Okay, so just the bottom line that you've already got business units that are operating above that level. Your expectation is that all the business units get there, and it sounds like it's really a mix of buying power and then also just getting the branches to be bigger through market share because you can.
And also
they're very
introducing
scalable.
products with a higher margin, which is part of what you said.
Okay.
Yeah, both product and channel
Constantly
diversification.
adding to the offering of products.
Okay, and then
Once the
just
channel is set, that gives us the ability to broaden the line.
okay, and then my second question is, I was kind of hoping to hear more about the new technology investments that are kind of going on behind the scenes. Just talk about the opportunity there, how much money you're spending, and then what the return expectation is.
We're going to answer a lot of questions, but we're not going to answer questions that help our competition. Sort of the Steve Jobs mentality. So we will not answer that. We will not tell you how much we spend. We will not tell you what our goals are. We can tell you that we are committed to enter the digital age in the biggest way possible.
Okay, fair enough.
Just to make sure we pile drive the 10 billion and 1 billion firmly into the ground. I'll stay on that. Have you guys looked at, kind of comparing best-in-class market share among your branches, and I'm sure you have some that are well above others. If I assume the whole Watsco network got to that best-in-class performance, how much does that bridge you from where you're at today up to the 10 billion? And I guess, is there enough to do in total M&A to close the rest of the gap? I mean, if it gets you to 7, is there 3 billion of acquisitions that you can do before the OEMs say, guys, slow down, you're a little too big a customer for us?
I think the last part of it, we're beyond that with the OEMs, who are their largest customer, period. But in terms of the 10 billion, we have developed strategies to do about 2/3 of it. So
Internally?
Yes.
Okay.
We got about 1/3 more to go. So to my way of thinking, it's a matter of execution on the 2/3 and to further develop the strategies to get you to 100%. What those strategies are, again, we don't want to enunciate them because it's in the future, and we don't want to invite the competition. We have learned that competitors listen to us, and we want to not have them know what we're going to do in the future. But it's in the industry. It's in the space. Most of it will come from the space we're in. I can tell you that we'll have more channels of distribution in our space. The Internet is an obvious conclusion that we'll be there in a big way.
And then with that 1/3 that you need to close either through additional execution or M&A.
Just haven't thought about it yet.
I mean, I guess the question is, do you see that being chunkier properties or, still kind of these ones and twos, moms and pops?
Well, we're not thinking M&A so much. We're thinking about development internally with what we're doing and expansion in the international business. But, I mean, I've already given you clues. They're talking about ductless. They're talking about controls. There are a lot of products that we have not entered and we will enter, and then there's a lot of efficiencies we'll bring to the channel, more than anybody else. That's our goal, be the most efficient distributor in the channel, to the vendor, all the way through to the contractor. And that will make us even more competitive than we are now, and that will drive margins.
Okay, that's helpful. And then just a question on the construction. Obviously, that's helpful cyclically right now. I know placement's still the biggest part of the business. But have you guys calibrated the sensitivity of what the revenue upside is from bridging from 900-some-thousand starts today up to something in 1.2? Mm-hmm. Obviously, the sell-in is more than just the system. It's all the parts and supplies that go on with that. What does normalized housing Watsco look like versus today?
It'll give us more revenues. We don't do those exercises. We just go out and kick butt and get more business. But I'll let the domestic head see if he wants to add.
I'm not sure I do want to answer. I think Al's answer is the right one. It's going to generate more revenues. When we look at equipment revenue value, dollar value, I typically assign a percentage of supplies to that, and it's something in the 30% range. So if it's a $1,000 HVAC system going into a new home, then there should be something close to $300 in total parts and supplies that go along with that. Now, do we get 100% of that? No. I mean, that's our goal, obviously. We want 100% adoption supplies to equipment, but that's something we continue to strive to attain.
Gotcha. So a typical house would be something around $3-4 grand.
Yeah.
Okay. And then just one last one, as long as I have the mic.
That's with contract labor, by the way.
Right.
Okay.
The 10% sales growth and 10% margin targets you have on a branch basis, obviously we're coming into a replacement cycle here, and you're getting that tailwind on the top line that makes the 10% growth easier. As we get a couple years out and the market's in a more stable recovery mode and those are harder to hit, do those dial back, or are there going to be a larger number of branches that say, look, I'm going to have to take a lot more share to get my goals, and consequently those guys don't get paid as much?
Al asked me that question yesterday. There's a lot of bandwidth out there for us to, pick up and gain additional share of market. It may not all be in equipment, but there's, as we diversify our product portfolio, there's a lot of opportunity. And I don't think that's ever going to run out of runway.
Our principal channel is through the contractor. We're the biggest and best, and we will always defend that position. But there are other channels. I gave you a clue about the Internet. There are other ways to get our product to the marketplace that do not use contractors. They're getting it somewhere else, and we are planning on being the largest in providing our products to the non-contractor-based customers. And that's why the investment in technology, one of the reasons.
Thanks. Just want to ask about the refrigerants and the energy efficiency opportunity. Just so we understand, I think there's some misinformation out there, but for the refrigerants, we don't know what the government's going to do, but is the opportunity that there's a shortage of refrigerant and then therefore there's kind of an early upgrade cycle as nobody wants to pay $800 for refrigerant, so they buy a new system? I mean, is that what we're talking about?
That's what the dream has been for the last 10 years. It hasn't come to fruition, obviously. We came close in the first half of the year where we saw a lot of sales pulled up because the refrigerant prices were high. Personally, and this is my opinion, I think for the next 18 to 24 months there's not going to be any shortage of refrigerant. we're going to be doing just fine. So I don't think that's going to drive it.
Okay. And then to the energy efficiency question, again, we don't know what's going to happen, but is the dream that in 2015 we get this regulation where the South has to be upgraded to SEER 14 or higher?
Right.
So what's the math there? Because that's your biggest percent of sales. So it's about 10-15% higher ASP for the 14 multiplied by 70% multiplied by equipment, which is 50%. Mm-hmm. Is that the opportunity if this does happen?
That's the dream, but as I said when I talked about it, I think that's going to have a rocky road, that the regional efficiencies are even going to be effective. So it really hasn't been something that we've been really diametrically focused on. Yeah, it would be wonderful. But if you consider that just about every new home that's built in the Sun Belt or any place in the U.S. is going to have a 14 SEER minimum in it anyway, because that's the only way the home builder can get his Energy Star. So not that much of an impact, but it would have been good.
Okay, thanks.
All right, maybe let's go back to the 10 billion thing for just a second. Maybe I could ask it this way: if the U.S. is 86% of your business today, at 10 billion, what percent approximately would you see that being?
These aren't calculations that we make, and I understand why you ask them. You're analysts and you want to make projections, but we don't do that. We just see an opportunity and we go after it. And how it ends up, whether it's 15 or 30%, we just don't know. But we're very aggressive with our ideas, and we've scaled the company to the point we can fund any of our ideas. What we won't ever do, we won't risk the company for any idea. We're very conservative in that respect. We'll invest, but we will not take chances with the whole company. But our culture, this is the new words I'm using with them, is massive experimentation. That's what we're becoming in the digital age. Our company is. We're going to be experimenting in a lot of different things. We don't know the exact outcome of those experiments, but where we have winners, we will run hard into it. Where we have losers, we'll drop them. And eventually, I can give you a picture where I think long-term this will be a data-driven company, right in tune with the digital age. What we're doing today, you won't even recognize in the future. And all the benefits of that will be a very, very efficient channel for our vendors and for our customers. And I think we're going to lead that revolution. That's why we call it the revolution of the industry. And we, with our scale, can afford it better than anybody else.
Okay, I won't even ask you what percentage you think commercial will be at 10 billion, so I'll just assume it'll be greater than it is today. Okay?
I could make up a number, but...
All right.
16.2.
Bigger than today.
As I said, we see opportunities and we chase it. We don't know where it's going to end up.
Okay, well, then let me at least ask this question. Paul, as you're looking at the ductless and the VRF, as we sit here today, do you have the right vendors to go to market, or is that something that still needs to happen before we can do that?
We're still working on that. We have a number of the right vendors already in place. Yeah. We're ready.
But I think that's a very fundamental question. And he mentioned earlier that the U.S. manufacturers make 5 million units out of a tens of million market. So we will be dealing and are dealing with Asian manufacturers. That's where the manufacturing center is for the ductless products. It's in Asia, which is Japan and South Korea, China, Thailand. And as I said, we have relationships. Those relationships will grow significantly as the time passes.
Well, from a ductless standpoint, though, that's necessarily a new construction application.
Not at all.
Mostly. I mean, if your house has ductwork and you have a system, you're not just going to put a ductless
system. Actually, we see more opportunity in the commercial side of that.
Commercial, right.
Yeah.
Okay. But from a residential standpoint, it'll take time to evolve because
I agree.
it'll generally be... Okay.
I agree.
Understand. All right.
Yeah, thanks very much, Sam Eisner at Goldman Sachs. So just a few questions on how you're thinking about new vendor relationships. Obviously, the carrier enterprise transactions have been very strong for the company. So just curious where you see potentially new vendors coming in. Who are you, not necessarily naming them, just curious where those talks stand today.
I'm going to develop a philosophy with that question, which I think about a lot. We're very dependent today on one vendor, and that vendor is Carrier. That should be obvious. So that's not a risk that I particularly like. Not that they're not a great company, a great partner, but I don't like concentration of vendors. So we are very dedicated to increasing the relationship with vendors, and that's why I mentioned the Asian vendors, as well as United States vendors. We are very aware that 50% of our revenue comes from Carrier, and we need to decrease that concentration. As I said, I want to emphasize, we think Carrier is a great partner, couldn't ask for a better partner, but we know that our company has to evolve beyond 50% being in one brand.
And these talks are ongoing, they are...
Yes, we had one this morning and one this afternoon. No, these relationships, particularly with Asians, take a great deal of time, but when they click, and they will, and they are, it means a lot to us.
And then just secondly on CapEx, obviously you put up a great chart showing cash from ops and CapEx, but it sounds like in order to hit some of these growth strategies, there will need to be pretty substantial investments in technology, in potentially new distribution centers. So just curious how you're thinking about CapEx going forward. Should we expect to see a more substantial ramp in CapEx over the next 3 or 4 years?
Another great question. Yes, we're going to spare nothing to be the company that I foresee in the future. And you will see the CapEx, primarily technology, in increasing amounts. But you will see the return also coming in terms of revenues and income. It will never be a company with a great amount compared to others with CapEx. It's just that our CapEx will increase to meet what we foresee in the future.
Thank you.
Paul, a couple gearhead questions for you.
Gearhead. Okay, thanks.
First,
I would call it egghead, but you call it.
I mean, I'm trying to be polite here. We're on the transcript and everything. I've talked to a couple of the OEMs who seem to suggest that from a technology standpoint, that a lot of their 13-SEER product can wait as 14-SEER with very little change. How does that relate to any kind of, I guess, A, pre-buy, or B, big pricing adjustment as that eventual energy efficiency step-up happens? I mean, are we just going to see a 10% price increase on the same equipment? Just curious if they've articulated anything or
No, they really haven't yet. And most of them, obviously are busy in their labs trying to innovate ways in which they can reduce the cost of a 14-SEER product or a 15-SEER product. So, I think what we saw with the 13-SEER when that was introduced, we saw the price spike up and then we saw the price come down when everybody got ramped up their volume against it and got their technology heads around the idea that they could cost reduce the product. So I don't see it as one of those huge moments where we're going to all of a sudden have a 10% increase in revenue just because 14-SEER is there.
Gotcha. And then, obviously, we've talked a lot over the past couple of years about a replacement cycle, but it seems like that's mostly contained to the cooling side. Do you think that there is pent-up demand for furnaces? And I guess if so, do you have any way that we can calibrate that?
That's been a question I think every quarter, every year for the last since 2008 or 7 or whenever Trane first brought it up. But as far as the heating side of it, I think we're looking at two forms of heat nowadays. I think we're looking at heat pumps and we're looking at furnaces, and we're seeing heat pumps moving further north as the technology on heat pumps has become improved. And I think just the natural way a heat pump operates, you're going to see shorter life cycles on heat pumps than you will on gas furnaces. So I think we installed an awful lot of heat pumps in 2006, 7, and 8, and hopefully we'll start seeing some of that replacement market popping up in 2014, 2015.
Gotcha. And then just shifting over to the OEM side of things, and Al, I guess I'd go back to your comment that you just made on maybe wanting a little bit more supplier diversity on the OEM side. does that mean if a property became available, particularly some of the larger carrier distributors, or I guess one large carrier distributor out west, if that property was available, does that mean that you'd shy away from it for the sake of diversity, or?
No, I don't want to mislead you. We would take that opportunity and acquire it as soon as we could, if it became available.
Gotcha.
I'm not saying we're going to stop growing with carrier. I'm just saying I see that we need to diversify as we get to 10 billion. Now, carriers' purchases might double during that period, or triple. Who cares? So we're looking for opportunity in all markets, in all brands. And all I can tell you is that we want to diversify. Do I have any specific idea? No. But do I think I would buy carrier distributors? Absolutely.
And then how do you feel more broadly about OEM consolidation? There's obviously been some chatter that, there are a couple folks who could combine. Would you view that as a neutral, net positive, net negative?
Well, let me ask my strategy guy.
Yeah, I think we're entering a different world right now. I think there are going to be consolidations. I mean, if you go back 20 years ago, we had a lot more OEMs than we have today. We've been able to prosper, grow with fewer OEMs. When we look at who the rumors are and the whispers are, we virtually do no business with the people who are being whispered about. So I don't view that as a negative.
We don't do business with them yet, but we will, we hope.
And then the other thing that we've been talking about is our relationships growing and expanding with a whole new cast of characters and a whole new cast of OEMs coming in from Asia, from Korea, China, and from Japan. Big companies, big capable companies that are coming into the U.S. market. So I think there's going to be more OEMs. It just isn't going to be the same old names.
Right.
So.
And then I guess in that thought on some of the new Asian guys, any changes out of Goodman with Daikin ownership, and have you been able to pull in some of the traditional Daikin product at a faster rate with those two businesses being together now?
Oh, Steve, why don't you cover that?
Yeah, I think it's still evolving. Daikin Goodman, while they're two good companies, two very solid companies, they're really trying to find their way the other way right now. They're trying to determine where they're going to layer in Daikin products on top of Goodman, what they're going to do with distribution. Are they going to allow independents to have the Daikin brand and retain the Amanda brand? So there's a lot of unknowns out there right now with regard to the Daikin Goodman play.
Paul? On the logistics, could you explain a little bit more about what you're thinking there? Is this looking at cost savings across the enterprise, as well as, or maybe a more working capital management,
Yes.
new ERPs? I mean, just a little bit more
Yes.
of
Yeah.
All of it.
Yes, we are. Those would be the logical things. Yeah, we're looking at how can we take our footprint? We got a 13 million square foot footprint today, and how can we figure out different combinations where we can get into some cross-docking, get into some DCs, get into some other ways in which we can move product around. Also working upstream with our vendors. We have some wonderful vendors who are anxious to work with us as far as being able to assist us in better order replenishment systems than we've seen in this industry. How can we take 13 million square feet and you can either reduce it or you can expand it and have 700 locations with 13 million square feet if you have a better replenishment cycle. So we're looking at all ends. Carol has assembled a team that's working on this, and frankly, she brought in a team from outside our world. They're not HVAC people. And so they're looking at things in better ways, new ways, and being creative as far as what the solutions are and adapting from other industries as opposed to just trying to improve, the HVAC saga.
So I don't know who wants to take this, but the $35 billion North American distribution market, remind us again, what % of that is owned by the captive OEM distribution piece?
Yeah, I mean, there are 4 OEMs who have networks. There are 4 OEMs that have networks, and I mean they have some measure of public disclosure that talks about what they distribute. It's probably in the $4 to $5 billion range would be my estimate based on what they publish.
And then, when you want to diversify the vendors, are you talking about maybe buying some of that captive OEM business, or is it more going to be with the family-owned businesses that have carved out, pieces of good?
Yes and yes.
Okay. I figured out that was going to be the answer before I even asked it.
We will buy most any distribution business. It's a quality business that we can build it thereafter in our space.
Okay.
We just are very aggressive in that. We bought 69. It's worked very well. And I don't think we're going to stop that. We're going to maintain a conservative balance sheet. That's our culture. And we're going to fund any opportunity. The bigger, the better.
And then 2 quick carrier questions. Can you remind us how many family-owned carrier, businesses are out there? Is it
40.
There's 40. And what approximately is the revenue potential?
I'm going to estimate it's probably going to be $1.5 billion.
Okay. And at some point, you'd like to own all those, I'm assuming. Right? Okay.
Can you help us with that?
I know a few of them.
At $10 billion, that would mean Carrier would be 30% of our business.
Right. So then my last question is, with Carrier, do they offer a ductless product? They do?
They should answer that for themselves, but as their one of their distributors, one of the 41, I would say they are certainly getting into the business, and we know it now.
Okay. Because I think that's a change. I don't think
They partnered up with Toshiba.
Oh, okay.
So it's a Carrier Toshiba product.
Right.
And Toshiba is a magnificent Japanese company in this product line.
Right. Thank
But then again, understand that we have other distribution companies that don't distribute Carrier. And that's the opportunity for other manufacturers to join us, other vendors to be increased. And we are in the process of evaluating who will want us and what we're going to do with it.
Thanks.
But our goal is to be the largest in the United States in the duct-free business, period. As we are now the largest in the ducted. That's irrelevant right now.
If I can just come back to the profitability question. Obviously, gross margins, in the kind of low 20s here. I mean, is there any way to kind of take that up in order to get to the 10% range? I mean, how do you think about pricing? How do you think about cost? It seems like there could be some avenues there for you guys to
I
get
think
better.
that the biggest opportunity for that will come from new products. That's what I think. And a different mix, a slightly changing mix more towards parts and supplies. Equipment is a very competitive product, and there's not much we can do about margin there.
And then from a regional standpoint, with Canada and Latin America certainly looking to double, are those more profitable portions of the company that could also benefit the mix as well?
I want to tell you that. You invite a competitor in there. We like it the way it is. There's profits in both international and the American market. I just think we're going to reach our goal. I don't know when. And then the next generation will have to figure out what they're going to do.
Sounds good. Thanks.
Do the OEMs have the right demand visibility or, I guess, confidence to get price again in 2014? They seem like a big outlier among maybe some other industrial verticals in the ability to retain and actually get price as commodities have been a little squishy. Can that happen again next year? I know this is typically the time of year when they talk about it.
Yeah, they don't have copper to kick around anymore, so. But they still have a good reason to have price increases. We have a couple of OEMs that have already announced small price increases, 2-3%. But generally, that's a more realistic price target than shooting high and getting low. So I think it's going to happen.
Do you think the yield on that 2 to 3% in terms of what they actually realize is going to be pretty
Never
close
have
to
in
it?
the past, so we'll have to wait and see. Yeah, and plus, if new construction kicks up, obviously that has a whole different dynamic.
Right. But I want to add that the vendors, when they increase prices, are also improving what the consumer gets. It's not a one-way street. And it's not commodity drives part of it, but they're also enhancing the product.
Oh, sure. Right.
And
No,
so
I'm
I
not-
think
I'm not
everybody
suggesting
wins with
they're
price
destroying
increase.
people.
I think The vendor wins, the distributor wins, the contractor wins, and more importantly, the consumer wins. The benefits and the attributes of cooling and heating have increased substantially year after year. And I think they'll have a lot more to go. Paul's already talked about this in terms of the wireless world. So do you want to do this again next year down here, or would you rather have another location? Down here? You're South Beach people? Well, Barry then picked the right destination. I've been at Watsco 40 years, and I have to say that listening to our speakers from our company tonight made me very proud. They're very articulate, they know what they want, and never seen it better. And I think it's going to get better the next 40 years. So with that, I'll leave you with, hopefully with a lot of confidence that what you've seen in the past will continue even better going forward. Thanks for coming.